Globalization was the project of a transnational overclass. Protectionism is the rebellion of the nation-bound working class. Michael Lind.
Welcome to Analyzing Finance with Nick. I've been talking a lot about the trade war lately. In fact, I did 2 live streams really about the developments going on in the trade war with the US and the rest of the world and China, and what it means for markets and the global economy. However, there's another angle that I think needs to be addressed, and I think this audience in particular would appreciate, and that is the social class angle. And deep down, if you really think about it, the class war and the trade war are one in the same. When the news of the tariffs came out after Liberation Day, there was a divergent response really on social media and just among the general public in terms of how people felt about this. Those who held significant stock portfolios and the cosmopolitan classes globally have particularly been sour on this, and they are fearing that this is going to result in a worse reputation for America, that international people will be hostile to American tourists, that the value of their stock portfolio is going to go down, and this is going to mean extensive decline in corporate profits and a recession which will disproportionately hurt their investments and result in possibly declines of 20 to 50%, or even in the worst left tail case, even more. And then on the other side, you've seen a different response, and this is the one that is more interesting to me. And it's interesting because these so-called conservative people, who in theory should be more free market, are responding in a more anti-market way. And supposedly the anti-market left-wing progressives in America all of a sudden are coming off as super hardcore capitalists when it comes to the discussion of trade and tariffs. It's amazing where you see these same people who are suggesting even worse fiscal policy solutions to the deficit, such as raising income taxes or instituting wealth taxes, yet at the same time can't stand tariffs. And if you want to know more on that, I did have separate videos about the differences between the tax structures and the financial infeasibility of relying on just taxing solely the rich. If you look at the fiscal impact really of the tariffs, it is the equivalent of raising the income tax on every bracket across the board from 10 to 25%, depending on how severe you think the tariffs will be in terms of rerouting trade elsewhere, versus people willing just to eat the tariff price. And the other people who have been complaining quite a bit about the tariffs are those who import a lot of luxury goods, such as high-end European designer clothing, luxury cars, French wines, etc. The other side, who is supposedly the conservative class, are actually taking a different tact. Like, these people normally who'd be supporting business and free markets and capitalism are taking the perspective of, it's about time. Or one tweet, I don't remember who the author was, but she kind of represents the broader view of the new MAGA coalition's view on this, is that, okay, I don't care that your stock market went down. Nobody cared when Jimmy Carter and Ronald Reagan got rid of the jobs for my aunts and uncles and parents who worked in the factories. Or nobody cares that all these fat company towns in middle America got hollowed out by people moving their manufacturing overseas, or outsourcing took away my job or my family's jobs and made us a lot poorer. Like, a lot of younger people too said, look, the boomers deserve it. They stole a lot of our wealth over the years through policies that are designed to increase shareholder profits, but at the expense of paying young people living wages. And so you're seeing a lot of Gen Z conservatives actually rooting for the stock market to go down. Part of this, from a selfish perspective, does make sense, because if you're a young person and you haven't acquired a bunch of assets yet yourself and you're early in your career, you want lower valuations. That means you can invest at lower prices. Generally, if you're under 35 years old and you haven't already made your major wealth from selling a business or something like that, a bad stock market is generally good for you, because that means you can reinvest at lower prices. Whereas if you're somebody who's later in their career or has already acquired a substantial nest egg through a liquidity event, if you weren't diversified into fixed income, this is the worst thing that could happen to you, because it could delay your retirement or force you to go back to work in a worst case scenario. In a more modest scenario, it just makes you feel a little bit more financially insecure and possibly have to have a more modest lifestyle in retirement. So there's this age component really too, that a lot of younger people are like, look, I would rather have a lower stock market and see these boomers not be able to live a life of luxury if it means that the economy might be realigned in a way that can provide younger people, particularly men who did not go to university, higher paying opportunities through the onshoring of America. And even if the long term, most of the onshoring of America is going to be done by robotics or moving factories to Mexico, there are short-term jobs that are going to be created, such as construction of all these factories, building out the electrical infrastructure for these factories, new jobs at the ports to reallocate flows of trade, AI engineers, robotics engineers to design and build and maintain the robots that will be doing most of the work at these factories. So there is something like, there will be some jobs. It won't be as great as hopeful, and it won't be at the halcyon days where you basically get paid the equivalent of a six-figure salary today to turn some widgets in a factory in Michigan. Like, that's not coming back. But also geographically, a lot of the heartland is going to be the ones who benefit the most from an onshoring of America, because in the coastal places where a lot of the upper class live, the real estate prices are just so high that it doesn't make sense to build factories there. It doesn't make sense to have industrial warehouses in a place where the best use is apartment buildings or things or more like that can generate more revenue per square foot. So that stuff's going to be moved to the interior of the country, the parts that have been hurt the most from manufacturing moving out. So there is that dynamic of why you would see the working classes support protectionism, is because any jobs gained from protectionism are going to be appealing to them and is going to be appealing geographically to their region. And the other thing is that consequence really of protectionism will probably be lower real estate prices, or at least real estate prices that are less likely to accelerate. And why do I say this? One, incomes are not necessarily going up because of protectionism. In fact, real incomes might slightly go down depending on the product due to some of the costs of tariffs being passed on to the consumer. And so if your base basket of goods and services you buy is more expensive, then there's less income remaining to be spent on rent and mortgage payments. And that will lower demand for real estate, and as a product, lower prices for residential real estate, because real estate is priced ultimately, especially outside of a few gateway cities where there's a lot of investor capital and speculative capital, on the ability of the local population to make rent or mortgage payments. And a lot of the reason why housing was able to go up so much faster than inflation over the last 25 years is because the costs of other goods and services, manufactured goods, was held down due to outsourcing and international trade, keeping the price of manufactured goods low, and so therefore that opened more disposable income towards residential real estate. And for the more fluent, it opened more domestic income for travel and vacation to be spent on Airbnb and things such as that. And as a result of there'll probably be a lot less demand for vacation rentals and Airbnbs, which will also open up supply for real estate for permanent residents and thus reduce rents as well. So there is a substitution effect. Whereas only if you have the same amount of income and you spend more on goods, your ability to spend on housing goes down. This hurts people who have sizable real estate wealth right now, and people who live in communities where real estate is a big industry or work in the real estate industry and need property appreciation or rent appreciation for returns on their properties to make sense. And so that is another element of the class warfare, is that the real estate class is probably not too happy about this. And the other thing is that this is going to discourage likely international investment in real estate, particularly from the new elites created from globalization and trade. Because globalization and trade ultimately was a redistribution from the lower middle classes of the developed nations to the elites of the developing countries. And so now you have a new class of new rich all over the emerging world and in a lot of newly developed countries as well. And they want to put their newfound wealth into they perceive as safe assets, which some of that is American real estate. There's also the reason they want to send their children to colleges in the United States and provide them a place to live too. So you have all this flows, and that artificially bids up the real estate market, and that as a consequence prices out the middle and working classes out of their hometowns, or makes them have to live a much lower standard of living than they would have otherwise because of the cost of housing. And protectionism reverses those trends, and it also means you're less likely to see wealthy foreign investors or wealthy foreign gold card buyers come to America to buy these properties. The other class dynamic of the trade war is really the unwinding of the disinflationary impact of outsourcing manufacturing. For the past 40 years, outsourcing of manufacturing and even some service roles of the economy to much lower cost countries has created the effect of having inflation much lower than it would have been otherwise if you had kept it in the United States. Overall, I think this is a good thing. I think high inflation is generally bad, but low inflation disproportionately benefits the elites, whether it's the political class or the upper classes, even if it's good for everybody. And the reason why I say this is because inflation is kind of the market signal showing that the government is inefficient, because inflation for the most part is created through too much money chasing too few goods. Sometimes there's supply shocks that cause inflation, such as the oil shock of the 70s, but most of the time inflation is more demand pull driven, and that is a cost, and that excess demand is often created by excess liquidity through government stimulus on the fiscal policy side, and or excess liquidity through ultra loose monetary policy, or not even ultra loose, but looser monetary policy than you should have given the economic circumstances. And you can argue, particularly since 2000, we've had artificially loose monetary policy given the economic circumstances. And usually the check on that is that yields would rise due to fears of inflation or realized inflation, which would force the bond market to react harshly to such a policy, and the Fed to react as a reaction to the bond market. However, in this case we've had with globalization, a lot of the inflationary impulses that were going to the economy were papered over due to low interest rates and the cost of manufactured goods being held down low due to offshoring. So if you have a government that is consistently running higher and higher budget deficits, normally in most countries, and this is especially common in emerging economies, that would result in higher inflation rates, the bond market tanking, and investors losing confidence in the economy, and often a down cycle. However, when the U.S. was able to outsource a lot of its costs to lower providers, the inflation numbers never went up. So the politicians never got the signal saying, hey, look, we can't sustain this deficit spending. And then the other problem is the Cantillon effect, really on top of that, where those who are closely connected to the money tend to benefit the most from the increases of money supply, which is whether it's those who are getting the favorable contracts from the government directly, or those who hold assets where people put their money that do not have a marginal propensity to spend. Like the people who are already wealthy, their incomes are well above their cost of living and their lifestyle expenses. So they just reinvest that, whether into the stock market or the bond market or real estate, and that causes valuations for stocks and real estate to go up. And for bonds, it creates more demand for bonds, which also paradoxically lowers interest rates. So that is the component really. So lower inflation, especially if you still have the same amount of government spending that normally would cause higher inflation, causes asset prices to go up and therefore widens inequality. And the reversal of that reverses all those things. So there's like a class warfare dynamic. If you restrict trade, and therefore you're going to get the inflationary impulse of having to use domestic workers or domestic supply chains, then that puts more pressure on the government to balance its fiscal budget. Therefore, the excess money printing cannot really be as available, and government spending beyond the means to pay people off cannot really go there. And so as a result, the economy contracts and the working class benefit on a relative basis. The other thing is a lot of the inflation in the 70s was caused by the higher negotiating power. Like, demand pull inflation is often driven by a tight labor market. And those who benefit the most tight labor markets tend to be those on the lower end of the labor market, because the supply of labor relative to demand is more cyclical. And so when wages go up the highest, often for the working classes, is also often the times when you have the highest amount of inflation. Like, the losers of high inflation were not the working classes. Generally, especially if you're working near cost of subsistence, wages would have to go up that level, or there would really be no point of working below the cost of living. However, the middle classes, the ones who are on relatively fixed incomes, are the ones who are the biggest losers of inflation. The wealthy tend to lose if inflation is high enough too, but it's not to the same degree because they can hedge it somewhat through the right asset allocation strategies. Whereas the middle class don't have enough assets that they can hedge themselves and actually compensate for the loss of the purchasing power of their income. So they're the ones who tend to get hit. And so a lot of, again, inflation is inefficiency, and a lot of inefficiency in our society is quote unquote middle class jobs. And I've talked about this before. So that's another really class war dynamic really when it comes to trade and protectionism. Protectionism tends to be favored by the working classes because it boosts their wages, it creates more job opportunities for them locally, and the income inequality goes down because they don't suffer from higher inflation as a consequence of this nearly as badly as those in the middle classes and the above. And also, there's less excess liquidity to bid up asset prices, particularly real estate. And I think real estate prices are the bulk of the modern class warfare. And until you're going to have this issue of populism is a byproduct, and I'm going to go into this in my videos of the booms, of basically the core cost of living for middle class people continuing to go up higher than inflation. And the biggest expression of that is the housing market. The reason why it doesn't look like things are that bad for a lot of these people economically is because you still have positive real GDP growth because the deficit continues to grow. However, if you look at several decades in American history and you subtract the average annual deficit from the real GDP growth, and you have often much worse numbers. And there's a common pattern. In the boom times, you have very high real numbers because the deficit is low or there's a surplus and you're having a lot of economic growth. Whereas in the bust times, the nominal numbers, real GDP numbers, look decent, but at the same time, the deficit's really high. So if you have the real number adjusted for the budget deficit, it's contracting. The government is essentially crowding out the private sector, but it's covered in the fact that G is part of the GDP equation. And Secretary of Treasury Scott Bessent put this really well in his interview he did recently on the Tucker Carlson show, which is the idea that we have a record amount of people going on European vacations in America. At the same time, you have a record amount of people going to food banks. You have 88% of stocks owned by the top 10% of Americans, and half of Americans don't own any material amount of stocks. And the remaining 12% of stocks are owned by the remaining middle 40% from the 50th to 90th percentile of the population. So if the stock market really goes down a lot, over half the population really doesn't have that much to lose. Their lifestyle is not going to change that adversely because their stocks go down. And so the political calculus here is not really as straightforward as saying, oh, stocks are bad, that's going to cause a lot of people to overturn and vote the other way. Yeah, it may cause the more people with the higher propensity to vote, the more educated upper middle classes, to possibly switch their votes because their stock portfolio goes down. They're more likely to turn out. But given recent economic shifts over the last 30 years, the greater concentration of stock ownership has made this class less powerful electorally. The other really component that I want to talk about when it comes to this is that the stock market and the economy are not necessarily correlated. And people say, like, Wall Street, if Wall Street goes down, Main Street has to go down with them. But that's not necessarily true. And it's the other way around too. If Main Street goes down, Wall Street necessarily doesn't have to go down with them either. And I'm going to cite two examples of this in history. The first one, which I think is the most likely comparison to this scenario, would be the 2000 to 2001 recession, which outside the San Francisco Bay Area was very mild for most Americans. Unemployment did not spike that much if compared to other recessions in this time period. But you saw massive losses in the stock market, with the S&P going down more than 50% peak to trough, and the NASDAQ going down almost 80% from peak to trough. Yet most Americans' lives were not really impaired that much by it. Main Street did relatively fine. And then you have the opposite example would be the reaction related to the pandemic, where you saw a lot of Main Street lose their jobs due to lockdowns or just a more efficient society replacing them with technology. And on the other side, you saw stocks go in record highs. And you could argue with the 2010 booms, pre-pandemic was the same way. In '08, you had a lot of job losses, and you had a lot of people struggle to get jobs out of college, particularly millennials, which create a lot of the resentment, and incomes be held down lower than they should be for Main Street for a long time. Yet the stock market rallied and recovered relatively quickly, and you had real estate prices come back pretty quickly as well. And you saw a lot of venture unicorn funds printing new billionaires for random tech companies that did not really generate that much value in terms of hard cash. And so it created a sense of unfairness where everybody in the financial industry are connected to Wall Street flows did well in the 2010s, but most of Main Street or did not. So those are kind of two examples of how these can diverge. And I think that the current administration is somewhat betting on this is going to be more of a Wall Street recession like 2001 than a Main Street recession like it was in the 2008 and the reaction post-pandemic really in the economy. I know this sounds kind of like a ramble, but I've had a lot of thoughts really about the trade war and how it has become an expression of class warfare and the forces that are causing this to happen. Let me know if you have any questions, and thank you for